Hello, AirDNA data nerds. Welcome back to the show, live and in person with my favorite economist, travel economist, international man of mystery, data gangster.
Data gangster.
Jamie Lane, our VP of Research, and of course I am Mariah Kamei, VP of Marketing here at AirDNA. Jamie Lane, I'm so happy to be in person with you. This is the best. This is how we should always do this.
One more month. Our separate offices, and now we're back in person together.
Yeah. Did you miss us?
I did.
Okay.
And I asked Demi, I was like, fly me back out. I want to do this in person. And she was like, whatever you want, Jamie.
Well, yeah, of course. Of course. I mean, that's what I say. Whenever Jamie asks me for anything, I'm like, yes, he may have it. He may have it. Jamie, you've been making the rounds on the podcast circuit lately. You were just on the No BS podcast.
Mm-hmm.
I learned a lot about you, my friend.
Yeah,
yes.
Mateo and John have a great podcast. One of my favorites that I listen to on a regular basis.
Yeah, it was great. And they went deep with you. They were like, okay, just start from the beginning, Jamie. You were born on a crisp spring day in 1992, right? I'm sure. Anyway, but they went deep in your experience on couch surfing, which actually took me back too. I was like, wow. My standards have grown. Like I've really come a long way since my couch surfing days. But yeah, so and favorite couch surfing story, real quick for the audience.
Real quick. So I hosted in Atlanta for years. It was started in 2008. So much fun. It really reminded me of traveling, but getting to stay at home and just get travelers sort of coming through, so you sort of keep that traveler ethos.
Yeah.
And hosted someone, a German girl, and then fast forward 2 years later, I was going to Oktoberfest in Munich. I was like, I wonder if she has a spare couch here during Oktoberfest. Or
like a floor.
Or a floor. And looked at her couch surfing page, and it was like, big, I do not host during Oktoberfest. Please do not ask. But I messaged her.
Yeah, you're like, I'm a friend at this point.
So she was like, actually, I'm moving apartments, and my old apartment's empty, and you can just have it for the week.
Oh, my God.
And so I got a free place to stay during Oktoberfest through couch surfing. So
oh my God. I love this. I love this. I had like one couch surfing experience because I'm a little, I don't know, maybe bougie on the couch surfing thing. But I went to Philly with my boyfriend, now husband, and my best friend. And I feel like this was the early days of Airbnb. We really didn't know what we were doing, but we were broke, right? Like we were very broke. We took the train. We were like, we can afford a $20 a night place. It was awful, you guys. It was awful. But I think about that when I think about just how much we've grown and like the standardization of the industry. And what I mean by that is like now there's like a lot more higher standards, both from host and guests. Jamie, you recently were featured. Well, we were featured, but I think you were quoted in it. Around one of my favorite topics, folks. Okay, favorite topics, cleaning fees.
Yeah.
And also the long, I was going to swear, but this is a family show, the long list of chores that sometimes are featured. What's your take, my friend? What's your take? I'm with the guests on this one. I'm pro guests.
Yeah.
Stop making me pay $300 and take out the trash.
So, and for the Wall Street Journal article, I sort of dug deep in the data, as we do.
As we do.
And typical increases in cleaning fees, and cleaning fees really do run the gamut. Like 1-bedroom home, like averaging $70, like 4 or 5 bedroom homes averaging $300 or $400. That really does sort of.
There's no standardization.
It reflects the effort that goes into cleaning those properties.
Okay.
So you've got a 5-bedroom home and it takes someone 4 or 5 hours to clean. You got to pay the person.
Right.
And over the past 4 or 5 years, typically cleaning fees are going up like 5%, which and maybe a little bit more than inflation.
Right.
Over the past 2 years, though, 2020. 2021, we saw big increases in cleaning fees. Average cleaning fee went up about 10%.
Okay.
But at the same time, the expectations from guests went up a lot. Like you wanted to know that your property was clean, sanitized, and that you weren't at risk of getting infection. And that took a lot more effort from hosts, from property managers, and that was reflected in the cost of the cleaning fee. Airbnb had their sort of checklist that you had to go through and sort of confirm that you were doing
Right.
all these additional things to make sure that property was safe. And I think the what that sort of meant in the eyes of the guests was actually really great, because you
There's a value.
knew more was being done to help protect you while you were traveling. Over this past year, cleaning fees are up another 8%. And that, I think you have to go back to the costs
Yes.
associated with cleaning. So average wages are up 5%. Average wages for leisure and hospitality workers are up even higher. So the cost of having those cleans happen is going up, just like the cost of everything up.
Right.
Inflation is up 8% year over year. Average cleaning fees up 8%. So I really don't see that the fees associated with cleaning has gone up any more than I would have expected.
Okay. So potentially not about, and that all makes logical sense. Like, I mean, I don't know if you can explain that to a guest such as myself. That's high maintenance. But when I'm weighing that with going to a hotel and having a maid come and clean my space and all of that stuff, do you think there's a world in which maybe there should be less chores? Maybe less chores for what you get? Do you think that consumers see the value? I'm spending $300 on cleaning. I'm getting $300 worth of a clean place to be.
Yeah, 100%. I agree. Like the number of chores that a lot of guests expect. And when they're thinking through the calculus of, I need to make the list of what my cleaner is going to charge me for, and then what can I get away with asking the guest to do, and knowing if the guest doesn't do it, then my cleaner is going to charge me for it. And if the guest is happy to do it, that saved me some money, and I'm going to increase the profitability. The other piece of it is...
Can they pass the savings to me then? I mean, just saying.
Maybe if occupancies dip a little bit more, you'll see some competition on cleaning fees. But that's also the tool that, and we sort of advise people to use cleaning fees on, is if you want to push higher length of stays.
Right.
And you can increase those cleaning fees. And a lot of hosts do and bake in some cushion between what the cleaning costs them and what they're actually charging.
Right.
And then if there's time of the years when they really want to make sure they're not getting short stays, 1 or 2 night stays, you can increase the cleaning fees, and that sort of indicates to the guest that if you're going to stay in this property, it should probably be 5 or 6 plus nights to make sure that cleaning fee doesn't have too much sticker shock over the course of the reservation. Gotcha.
All right. Well, this is all good food for thought and good rationale for hosts. I do see, and we're going to talk about this in a minute, and I think you're going to be pleased with me, maybe, potentially.
Yeah.
I did my homework, guys.
Okay.
But I think like one of the things that really strikes me is as we move into an area, and we'll talk a little bit more about this, where supply is sort of getting pretty saturated and occupancy is starting to flatline a little bit, right? Then we start to get into these things, like for instance, when I was looking at my last vacation that I was taking on, I really was weighing hotel value and cost versus Airbnb. So I think it's just a really great reminder to all the hosts out there and operators, right? Like that it is a hospitality business. It's all about keeping guests happy. And showing them that it's much more valuable for them and much more worthwhile to stay in an Airbnb, I'd say, or short-term rental.
Yeah, and in the environment that we've been in the past 2 years with really high occupancies, hosts and property managers have been able to get away with it.
Exactly.
They're essentially booked solid. They can push back more on the guest to either do more or pay more.
Right.
And if we get into an environment where occupancies are falling, hosts are now competing with other hosts for those guests.
Yep.
If you're going to make the choice of, okay, this person has 10 chores that I have to do and the other one doesn't, that may be the deciding factor.
Yeah.
And that could, and it's already what we're seeing now with cancellation policies. Of those hosts with more lenient cancellation policies are maintaining higher occupancy than those with more stringent cancellation policies. So each one of these things becomes a lever that you can pull to try to induce more bookings at your property. That's something you need to be really cognizant of, is what you're requiring, what your policies are,
Yep.
and what those are of the sort of homes you're competing with in your market.
Yeah, I love that. I think that's one of the advantages of building that very customized comp set, right? So you can look at it based on amenities and other things, and then really digging into things like cancellation fees, cleaning policies, be as competitive and niche as you possibly can.
Yeah.
I love that. All right, are you ready to be impressed? Are you ready to be impressed? Because I'm not the economist.
You went to art school.
I went to art school, people. Art school. Don't send your kids to art school, people. But I mean, it worked out for me. Maybe economy school's smarter. Might have worked out better for Jamie. But anyways, Jamie. Okay, are you ready? I'm just going to throw some facts at you. You just let me know.
Okay.
When I'm done. At what you think.
And I'll just react to those facts.
Yeah, like with shock and awe, or like I'll ask you a question at the end. Yeah. Okay. Yeah. So are you ready? So the stock market took its biggest dip. I was going to say something else, but again, we're a family show. Since June of 2020, last Tuesday, Bitcoin also fell significantly. The yield on 10-year U.S. Treasury jumped to its highest since 2011. Dollar stable and strong. I guess that's a mixed bag. That's what I hear from the investors in the space. And everything but energy costs are skyrocketing. So okay, this feels very roller coaster to me. I hear, again, I want you to be impressed, that a lot of this was driven by a new report on inflation that was released. What surprised you about this report, and what all these facts are that I just threw facts at you?
Yeah. So
fast facts.
Let's go back and start with the jobs report that came out at the beginning of the month.
Oh, okay. Oh, yeah.
Because for economists, this was like a Goldilocks report. Like, not too hot, not too cold. Like, It was perfect. Like, job growth was up, like 315,000 new jobs added. Like, that's great.
Right.
But unemployment actually went up 2 percentage points or 0.2% from 3.5 to 3.7.
Okay.
And that was from more people entering the workforce. Uh-huh. And then you actually had a pullback in job openings. So we didn't actually see a reduction in employment. We saw a tick up in the unemployment rate from sort of more people coming in.
Right.
Which sort of gives employers more options, reduces some of the heat on the job market. The income levels came down. The growth at least came down just a bit in terms of wages employers were having to pay.
Okay.
And it sort of pointed to that the Fed was going to be able to manufacture this soft landing.
Right.
That we were going to see unemployment go up just enough, job growth slow, and we may get to this like great point where we sort of avoid a recession and are able to pull in inflation down.
So you were feeling great.
I was feeling great.
You were feeling great. You were walking away just going, yeah.
But remember on the last video, and we talked about it, like what is the one thing you need to be paying attention to? And that's the inflation numbers.
Yeah, no, it was like just a pop quiz.
and those came out. And everyone was expecting the inflation numbers to be a whole lot weaker than they came in at, given that supply chain sort of woes were easing, shipping costs from China and overseas were coming down, gas prices were down 40% or 40 cents in the month. It sort of felt like inflation was going to come down.
Right.
And then we got the report, and it wasn't great.
It was not great.
And essentially what that signals is that the Fed's going to have to keep raising rates. More than likely, we're going to have another 75 basis points increase. I think it's next week. And that's going to increase risks of sort of the Fed pushing the economy into a recession. So that's what the stock market reaction was around. That the Fed, and there was a chance that like if it had come down a lot in the inflation numbers, then maybe the Fed could pump the brakes on having to raise interest rates, which could have led us to this soft landing. There's still, I would say, a 50-50 chance, but where if we would have talked at the beginning of August, I'd been like, all right, I'm 45% chance of recession. Like we're below 50%.
We were very glass half full.
And now, and that wasn't great news. So, and we'll definitely be watching it over the next few months. And I would say like this last one came in above 8%. If we start to see it coming down, and and 5-6%, that's going to be great. And the Fed's going to want to get it down to 2.5%.
Gotcha.
And that's
2.5's the goal.
That's going to take a significant slowing in the housing market. That's going to take sort of some pullback in other areas of the economy, which are going to cause some pain.
Yeah. That's why it's important to be prepared and to know these things.
Yeah.
And like to watch the news, which is what I did, guys, this week. I love that. Well, and it's funny, again, I spent my weekend planning 2 vacations for 2023, 2 family vacations. So let's talk about how this relates to what's happening with demand. I think that is one of the questions you get quite often is like, okay, but are people not traveling? Are they not booking in STRs? What's the headline? I know we just released our latest report for August.
Yeah, so the headline is still great. So demand for short-term rentals is above any level that we've seen in the past. We're still up 20% year over year in terms of demand and nights booked. As we looked out to the fall for in October, November, getting into December, demand's up anywhere from 15 to 20% year over year. So, and we don't see any weakness in booking activity yet. I was at a conference in New York last week with the CEOs of a bunch of the big travel companies, and each one of them was asked, like, are you seeing any weakness in demand, in any booking activity? And this is across sort of short-term rental and hotel companies, and there wasn't a single one that was able to point to any weakness in booking activity. They all see consumer sort of want and ability to travel is there, and really strong bookings as we head into fall. And that's even with hotels where generally there's sort of the transition from leisure travelers to business travelers.
Right.
And there was this sort of question of whether business travel is going to be back.
Yeah.
I was in New York, and we've been around the country going to conferences. It seems like most cities feel busy. I saw some recent figures on sort of office activity in New York was really getting close to back to pre-pandemic levels. The subway felt crowded. Like it really does feel like things are back and people are wanting to travel.
I love that. And kudos to you for taking the subway. I miss the subway. I never thought I'd say that after I left New York, but I do miss it occasionally. Okay, so demand, good, yay. However, the kicker is occupancy down, driven by the supply.
And occupancy in ADR isn't where we'd like it to be. So occupancy was down 4.5% year over year.
Right.
It's good. Still 7% above 2019 levels. But what really starting to concern me is ADR growth. So we're only, I think August was at plus 2.8%. Yep. So that's well off of the 10% gains in ADRs we were seeing at the beginning of the year. So you take a 4% drop in occupancy, only a 2.8% increase in ADR. That means average revenue per property is down.
Right.
And we've had 4 consecutive months now of average revenues declining across the U.S. And when you look at the markets where that's happening, it's the markets that are seeing significant supply growth. So that is sort of eating into the revenue potential of operators around the country. There's quite a few markets, and a lot of these were the sort of darling of short-term rental investment over the past 2 years.
Right.
Big Bear sort of even on a trailing 12-month basis, revenue per available listing is down 30% year over year. Lower Hudson Valley down 15%. Berkshires, Adirondacks, Cape Cod, each of these sort of big markets that were attractive to people sort of traveling from major metros are really seeing some weakness in booking activity, and especially on the rates as a lot of the higher end travelers that were going to these markets are now choosing other locations. Right.
Well, with the dollar doing so well, Europe is looking a little bit more appealing for luxury travelers.
And we just presented at the Vacation Rental World Summit last week in Porto on European booking trends.
Amazing event.
And most of the major Western European countries are now well above 2019 levels of demand.
Right.
And
Crazy.
a lot of that demand is coming from the U.S., of people sort of getting back to cross-border travel, and that's helping Europe and causing a bit of weakness in the U.S.
Yeah. Well, I think it just highlights the fact that you have to continue to be competitive. I mean, there's a lot of folks that have been in this business for a long time. They've weathered storms like this in the past. They know sort of how to shore up what they're doing, potentially take something like Big Bear and look to appeal to a different clientele, right? If you're in luxury, is there a way to sort of go to mid-level clients? But for new people, it's...
I think, we're seeing this sort of reversion back to 2019 levels.
Right, okay.
But what we're still seeing is there's interest, but
Definitely,
at a lower rate. So demand in these markets isn't going down.
No.
They're still accommodating more and more people, but you're just seeing the rate that people are willing to book at for these trips is less than it was last year. So you are seeing some a bit weakness in the ADRs in a lot of these markets, and that's what, as a host, you got to stay on top of if I'm not getting the bookings that I need to sort of make it work, and can you adjust that rate lever, maybe try pulling it down 5% and see if that induces bookings, or at least go in and see, and in your market, in your comp set, what are the rates that properties are at that are getting booking activity, and maybe adjust those expectations down or up, given there's still so many markets that are seeing growth in occupancy, growth in rates really pushing forward, given the type of guests that are still coming back into the traveling sector.
Yeah, and just like keeping that bigger pulse, right? Like going into those numbers every day, going into things like smart rates and really seeing what's happening compared to your competitive set or comparable set. I love that. And I think there is sort of this like concept of, like anchoring off the high. Somebody smarter than me, an economist, said something about like we often anchor off the high, right? So it's like when our stock portfolio was doing its best, right? We're like, that's where it should be. It should always be at like, so it's like, I think a lot of people in this business, especially if they started in 2019, 2021, right? They are anchoring off the high of 2020 and 21, right? So it's like bringing it back down to a base level, obviously. And
that's like, and the Big Bear example, like Big Bear is down 30%, but it's still at 50% over 2019 levels. So
exactly,
and as long as you didn't underwrite that investment off expecting 2021 to last forever,
right.
If you're an operator in that market, and you're probably still doing pretty well.
Yeah, there's still money to be, there's still profits to be had in this business, obviously. What other types of things can folks do to just sort of mitigate the risk? I think you were just recently quoted again in the Wall Street Journal, just offering some really practical advice to folks, right? Which was to save 10% of your profits just for oh shit moments. Oh no, I swore. You knew it was going to happen, guys. You knew it was going to happen. Oh shit moments with a property, right? You never know what's going to happen as a homeowner.
Yeah, and that's, I came from the commercial real estate side. So in commercial real estate investment, you sort of keep a CapEx reserve it's like your rainy day fund.
Right.
And you sort of build it up over time as a percent of the revenues that you're earning. And generally for short-term rentals, I suggest anywhere from 5 to 10% that you're sort of holding back in that rainy day fund.
I love that.
The sort of range 5 to 10% sort of really depends on the age of your property. If you got a 100-year-old home that things are always breaking, you're gonna have to replace the roof and maybe fix old plumbing, things like that. Maybe anchor towards the higher end. If you got
a party house, I don't know.
Yeah, brand new home where everything's new. You're not gonna have to replace the AC, the roof, anything like that. You can get away with 5%, and then it's just the odd thing that may happen.
Right. Like people breaking things.
Right, where you don't want to put your investment at risk that something happens, you don't have the cash flow to cover it at that moment, and then all of a sudden you're having to cancel bookings and you sort of get into a snowball effect.
Gotcha.
And then the other thing we sort of talked about in that article was the different risks to the investment. So you're either going to make your money in short-term rentals through appreciation of the asset.
Right.
So your home raising in overall value over time. of which Zillow just released the latest home value numbers. And we had our first month-to-month decline since 2012. So that does put at risk, and there's over half the markets in the country that are now seeing declines in home values. So if you're expecting sort of overall appreciation of your investment, if you've invested over the past couple of years, that's probably not a good assumption, and that there's going to be some weakness. If you're looking to buy now, that may provide some opportunities in certain markets where home values are declining. Then you've got the cash flow side. So how much money is that property actually making in income?
Right.
And that's what we talked about, sort of the weakness in occupancy, the weakness in ADR is going to create a lot of risk there. And then there's all the other risks. There's regulation risks. And we just had a hurricane hit in Puerto Rico. And we're going to see an impact of that on the short-term rental market for probably years, with homes being lost, residents being displaced and staying in short-term rentals. That's actually one of the things for operators in these markets that get hit by natural disasters. A lot of times short-term rentals are able to accommodate those displaced residents. And actually, if your home did survive, actually see a pretty big uptick. Airbnb usually puts out where you can make your home available
I remember
for people sort of free of charge. But there's these type of natural disasters can really increase the demand for short-term stays.
Yeah, absolutely. That's very interesting. I love all of that, Jamie. That's good advice. Are you doing any leaf peeping this fall? Is there anything that we should know about? What should we expect? What are people up to this fall? Like you said, leisure travel's obviously going to sort of start to peter out here, with the exception of leaf peeping.
So
Google it if you don't know what it is.
Being from Atlanta, and North Georgia mountains are big on the leaf peeping.
I had a feeling. We're in Colorado. We know. We dabble.
The beautiful aspens in the fall. There's definitely a lot of demand for fall travel. As I said, overall it's up 20% October, another 25% in November. So we're going to see strong demand in a lot of these markets for leaf peepers. And I think what's great now as we sort of get into these, can we call it post-pandemic yet?
I mean, you know my stance on this. I keep trying to cancel it.
But we still see more and more people with the ability to work remote, with the ability to extend long weekend trips into a week or 2 weeks and continue to work. And that's a lot of the amenities that homes have, like workstations, things like that makes that really easy. And if I'm going to go up leaf peeping this fall, it's probably going to be for a week.
And you're going to take your family. A lot of folks in my circle, they're like, I've got a business trip, but I'm going to tack on a weekend to it, and I'm going to bring my family along for part of it.
That's what we're going down to VRMA in Vegas. Are you going to stay an extra week in Vegas?
No, guys. We're so excited about VRMA. By the way, I'm getting a little too excited about VRMA. I know you're doing the golfing. I can't golf, so maybe I could be your caddy. Do you want me to be your caddy? Kind of
I can't golf either.
Scott's going, so it's okay, guys. We've got one good golfer.
I don't think our team is going to be up there going for the win, but we're going to have fun.
We're definitely going to have fun. We're definitely going to have fun doing it. But we're going to try to get in and get out of Vegas, which I think is the best.
Absolutely.
Best strategy there. Mr. Lane, I think that's a wrap for this one.
Cheers.
Good job. Cheers, friend.